All right, well, welcome everybody to this week's client support webinar. My name is Bennett McDowell with traderscoach.com, and today is May 1st, 2024. All right, so today we're going to talk about risk to reward. We covered actually last week and the week before a little bit on calculating your trade size. So I want to move on this week to risk to reward, which is part of the money management risk control process. Now, if you have any questions, feel free to ask that aren't related to that. That's fine, because again, this is a webinar where basically what's more important to me than necessarily covering any new stuff is to make sure that your questions are answered and covered in case you're having difficulty in some area. All right, so make sure you do that. And as far as I know, all software is working fine these days, so we're in good shape there. But of course, if you're having any type of trouble, let me know. And all right, so let me go on and do a few administrational items, and then we'll go ahead and get going. All right, so risks, of course, I've always got to discuss the risks involved in trading the markets or in investing, or actually almost anything we do with money, right? So there's always a possible downside. You kind of want to understand what that is. You just don't want to enter into something without knowing what the risk is. And I think that's a pretty sound, logical advice, and it pertains to trading as well. So in trading, basically, first step to protect your downside is to fund your trading account with money you can afford to risk. Now, even professional traders like myself, we don't trade our entire net worth. What we do is we focus on the fact that, okay, I can afford to risk this much of my net worth, and that can go into a trading account. And I suggest you do the same on your end as well. In case there's something called a market risk event that comes along, and like a terrorist attack or some unforeseen thing that comes out of left field, and of course causing the market to gap against you, and you get out at a much larger loss than what your stop would have carefully gotten you out at. So that's one reason why we do it that way. The other thing, of course, is to always calculate your risk on each and every trade that you want to take. And I have many books that can help you on that. But that way, when you go into a trade, you know what the risk possibility is and what the reward possibility is as well. So there's your risk to reward that we're going to talk about today. All right, and then finally, run anything that we do talk about in terms of, if we come across a stock that we like or something, run it by your financial advisor to be sure it's suitable for you. I don't know your personal situation, and of course they do. All right, here's my books available, and you can get these on our website. Many of you have them already, but the two you might want to focus on here that we are talking about today is money management for traders. All right, and then here's our software. Many of you have this. If you have any questions on the software, feel free to ask away. Same thing with the courses that we have as well. All right, so let's talk a little bit about risk to reward. And so I think here's TradeStation. If you have any questions on TradeStation, let me know. Here's NinjaTrader, let me know as well. So when we talk about risk to reward, I'm going to bring up the whiteboard. All right, basically, in a market, we have a move up, if you're doing this Elliott wave stuff. All right, so if this is a 1, this is a 2, this is a 3, and you've completed 4, and you think now you're moving up into wave 5 that should end above wave 3. Well, the earlier you get in to a wave 5 or any of the impulsive waves, the better off you are, because your reward is so much greater than getting in late in the trend. So if we talk about a wave 3, let's say we were to get in here. This is why I don't like chasing markets. If we were to get in here, the risk to reward, all right, may not be suitable for the trade because there's not much reward. So the risk is where we're going to put our stop in relation to where the market gain is possible. All right, so if you have any questions on that, let me know. So this would not be a good place. This would be a good place, right? Just like if we can get in here off the bottom of 4 and put our stop under here, well, then our risk is here. And then our reward is going to be whatever the fib extensions tell us the target zone is, right? And so we like to keep that risk to reward. Now remember this, 2 to 1 or 1 to 2 rather, in our favor. So if this is the risk, this is the reward, right? So we want the reward to be usually twice as great as the risk. So that's important. So when you're calculating your actual amount of shares or contracts, depending on what market you're going to go into, all right, that is going to be determined on your percent risk in the calculator, like what we talked about last week. So if you're using a 2% risk and you have a $100,000 account, well, your 2% is how much? Anybody? What is 2% risk of 100,000? Is it 1,000? Is it 2,000? Is it 50,000? What is it? Not going to go on until I get a little feedback here. It's 2,000, right? Of course. Okay, 2%, right? 2% of 100,000. All right. So, so you don't want to lose more than $2,000, right? But you will lose $2,000 because the idea is that if you're going to risk 2% on a $100,000 account, then you have to be prepared to lose roughly $2,000, right? Okay, so every time you lose on a trade, you're going to be losing 2,000. Every time you win on a trade, all right, if you're using the risk to reward of at least 2 to 1 in your favor, then you're going to be winning 4,000. Well, what if the risk is 1 to 1, the risk to reward? So every time you win 2,000, but every time you lose, you lose 2,000. Then what becomes important? Well, then how many times do you win versus how many times you lose becomes important. And that's called your basically win to loss percentage. So if you have a win to loss percentage of 50%, so in other words, basically you're losing as many times as you're winning, then if you're losing 2,000 and your reward is only going to be 2,000, your equity curve is going to be kind of at the end of the enough trade sample sizes about the same, right? Because you're winning as much as you're losing and you're losing as much as you're winning, right? So that is, so theoretically, if you have a system where you're winning twice as great as you're losing, then you can actually have a 50% system and be a net winner in trading the markets. Any questions on that? Now, if you're winning 60% of the time, now you get to see how much more you could win than 50% of the time, provided your risk to reward is in your favor. And what we like is at least 2 to 1. Sometimes we'll take a trade and it's 5 to 1. That's great. The higher, the better in your favor. But as a minimum, we like to keep it 2 to 1. Any questions on that? Alexander, you got that? Very important. All right. Okay, so let me erase this and come out of here. And the next thing we want to do is, okay, so how do we do this risk to reward? Well, let's just start off with a very simple situation. Let's say we want to go long on this pyramid here if prices get above it. So this is, notice it's blue in color. On your system, you may have the default color of yellow set. There's nothing wrong with that. You can use yellow. I use blue. All right, so it means it's not been confirmed. So we're not going to go long until we get what? Above here. And that's 740, right? Dollars. So that's a lot of money, right? It's Costco. All right, so our stop is going to be down here, right? All right, so very quickly, if we're going to use the PTF as a target up here, this is our target, and our entry is here, and our stop is here. Look at the distance. So this is the distance to get stopped out. And what's the distance for the profit? A little bit higher, but not much, right? Do you think the risk to reward is 2 to 1 in our favor? What do you think? What do you think? No, right? So this would be a trade you'd want to pass on. Because in my rule base, if the risk to reward isn't 2 to 1, I don't take the trade. So I'm looking for trades that can yield me more of a return than I'm really risking. And this might be, 1.2 to 1, but that's not enough, okay? So I would pass on this trade. Does everybody understand that? So Alexander, for example, give me a stock, okay? Give me a stock that maybe you're in or thinking about going into. And that goes not only for Alexander, but everybody here. Bill, that could be you, Dan, Lewis. All right, let's see, Alexander. TJ, are you in this one? Now this is an IPO. Are you in this one? All right, so now let me ask you a question. Where is your target zone on this? Let's say you were able to get in at the pyramid here, okay? So you got in a perfect entry here. So where's your target for this one? Where do you think the market's going to go? 55. Okay, so you think 55 is the target. So even though we pulled back to 46, you think it's going to go back up to 55. So if you went, where would you go in? Where did you get in? Where did you get in? Okay, so you got in at 18, way back in here. Okay, good. Okay, now what was your target when you went in here? Was it 55? And I assume at that particular point, maybe that was a 30. Okay, all right. So let's just take it back here, okay? And let me just erase this here. So he got in about here on this pyramid down here, okay? So let's just take his real life example. All right, so on this case here, you technically had at that point, all right, a PTF high here, right? Well, let's just go back and see how far back we can go on that. Let's try to get a target that makes sense here. Okay, so you had a PTF high here when you went in on this target here. So let's draw a red line here. All right, so when he went in on this pyramid, his target was there. So the high of this price bar is 25.85. So 25.86 would be a PTF target. Does everybody see that? Okay, does everybody see that? All right, so next thing we'll do is let's take a look at the entry, and the entry here has a high of 1820. So let's say 1821, Alexander did a PTF entry. Now his stop would have had to have been under the pyramid, right? Okay, or under the channel. Not sure where your stop was there. Okay, probably at the bottom of the channel would make sense, right? So let's say your stop was down here at 14, let's say 1431 was your stop. Okay, so now we're going to calculate that if we go in here when this pyramid gets confirmed and we put the stop at the bottom of the channel, let's figure it out. All right, so first thing I'm going to do is let's do the trade size. All right, so if our entry price, all right, of the PTF was 1821, we'll put that in there. And then we'll put the exit price at 1431. We got the calculator set up for the point value of 1 and the commission. And we're going to put the target price in. And the target price was 25.86. All right. And we hit calculate. And the risk to reward is 1.96. So the calculator is saying that if we enter here and our stop is here, then our risk to reward is 1.96. So if your hard fast rule is it's got to be 2, this would be a trade you wouldn't take. Now, if you reanalyzed it and said, okay, well, maybe I'll put my stop at the bottom of this pyramid instead. Okay, but you got to be careful about changing what your thoughts are on taking the trade, okay? But that stop is pretty close. And I'll just show you how that a stop here could change things. So this low here on this little pyramid here is 14.74. So I'm going to put in here an exit price of 14.74 instead of 14.31. And watch what happens now when we change the trade size, or the stop rather. Okay, so we hit that, and now we're at 2.20. So if you put your stop here, all right, which is fairly close to the bottom there of this little one here, then that would make sense. You could take that trade. That means you'd have to get out when that pyramid is hit. Okay, so and if you use the bottom of this pyramid, okay, you could do that as well. All right, your trade size would go up. So the combination of risk to reward is where your stop is, where your target is, and the trade size on this would have been 576, and the dollar risk would be 1998. Okay. So that gives you an example of what you should be doing really on every trade, calculating your trade size. And you know, what's interesting is sometimes when you do this, depending on the market cycle, not much may come up as good trades. Well, that's good because that keeps you out of stuff, right? That keeps you out of stuff. Now, if we go to the MES, for example, let's do this one. All right, so here's a situation that's kind of interesting. We've got a PTF down here for a target. We don't really have any pyramids here, but we have a high here. So let's just say you showed up on the scene and you just wanted to go short because you were trying to take advantage of down here. Well, right away, you can just simply, you could use a trade side calculator, but also too, what you could simply do is get a ballpark by drawing here. Your stop would probably go in this range here, because where else are you going to put it, right? And prices are here. So now, let me draw one more here. So if prices are right around this range here, then you can certainly see not quite 2 to 1, but if it pops up here, and you see it turn around, then you got a 2 to 1. All right. And then once you decide you've got what looks like to be a 2 to 1, then you can use the calculator and get it exact. Okay, to make sure. Any questions on that? All right, give me another market. Tell me what else you're thinking about trading here. Give me a stock. All right, SQQQ. So you're thinking about an inverse ETF. All right, Alexander, what's the point value on an inverse ETF? What's the point value? And what's your target, and why are you interested in this, taking a trade on this? Well, here, let's say you think this is going to have a correction. Okay, so let's take a look here. Let's grab our fib retracements and just go from here to here. Okay, so that's the target, right? All right, so let's say you want to go in now. Where would you like to put your stop? Under here? So if your stop is under this price bar here, then that's going to be a low of 11.23, so 11.22. That's where your stop's going to be. And if we enter, let's just say we go in at 12.24, which is where we are right now. All right, so let's go to the trade size calculator here and take a look. All right, so we're going to erase those variables and we're going to put these in here. So the entry is 12.24 and the exit would be 11.22. Now, when you have a range like this, I usually put the beginning of the range in to get a good idea. So when I put that range in, it's 2.89. Okay, so that's the risk to reward. Because from here to this bottom here, okay, there's about 2, almost 3 to get you up into there, okay? So that gives you a go. So that would be a buy if you wanted to enter right now. Okay? And the shares are calculated for you. The dollar risk is calculated. The cost of the trade is calculated. So everything is there for you, including the risk to reward. Now, if you're using just the trade size calculator, we call it the TSC, you're not going to have this portion available to you. Okay. Okay, that's going to be missing, including the cost of the trade too, I think. All right, so these are all missing right here. So you can calculate your trade size, but the risk to reward calculator adds an extra dimension to it. And you can, there's an upgrade price if you want to do that. That's very inexpensive. All right. But that's kind of the deal here. So again, we use this religiously, whether we're day trading, position trading, whatever kind of trading we do. That's kind of a very vital and important part of our trading rules, to always calculate not only the trade size, which we covered last week, but also to the risk to reward. I think those are both very important. Any questions on that? Alexander, you are welcome. Thank you. Thank you for your participation. Now, if you were going to wait, just out of curiosity, for prices to go above here, all right, that would probably lower the risk to reward too much. So let's just take a look at that. So that high is what, 12.99. So let's put that into the calculator here and see what, so we'll replace the 12.24, put 12.99, and watch how this affects the trade size and the target price. See, now we're down to 1.24. So if you waited until here and put your stop down here, then your trade size is going to be too small. Now, you have a green PTF on the 15 second, So there's a high probability we're going to take out this high, which may warrant an early entry, like right now. Okay, again, we don't trade in a bubble. So if you're waiting for a pyramid to show up here, according to the 60-minute chart, we should get that pyramid by the time prices get above the high there. So that would warrant an early trade, an exception, so to speak. Okay. All right, so has everybody got that? Now your risk to reward would be even greater if it keeps on going up through the target zones. The higher it goes in here, the more your return's going to be. So that's another thing. Just because our target is at 15, 19, it doesn't mean that you just get out there, but instead trail your stops up and try to take it as high as you can. All right, well, that's kind of what I wanted to cover today, because I think risk to reward is a really important aspect of money management when you make a trade. And the idea is that, you know, if you're winning 65% of the time, that's actually very good in the markets overall. And I'm talking about that 65%, including drawdowns and things of that nature. Okay, so you got to remember that. Now, the other thing that's really important is I'm not an advocate to moving your stop just to make the risk to reward work. And the reason for that is your stop needs to be set at levels that make sense. Okay, a pyramid, a bottom of a market, or a bottom of some major pullback where there's support. Just don't pick a stop arbitrarily out of the air so you can get the 2-to-1 risk to reward, right? Because stops need to be placed at significant levels in the market that have meaning. Okay, I think that's a very important thing to mention. All right, well, if there's no further questions, we'll call it a day here. Hope you found this helpful. But, you know, this risk control stuff is absolutely vital to doing well in the markets. I can't tell you how many people we have had as clients where they have found us after they didn't realize how important risk control was and wish that they had found this information earlier. So I commend everybody for being here. Had a good turnout today. All right, guys, we'll see you next week, okay? Thanks so much, and we'll put this recording in our recording area that you can access through the VIP portal. All right, have a great week, and we'll see you back here next week.